FOMC meeting fresh off the press, and we've got some things to digest. But if you've been watching these videos, you've been very much prepared for and ahead of the game, and most importantly, ahead of the market on what the Fed's been saying and the true words behind their actions. I just want to reiterate this. I have watched the previous Powell speech at least 3 or 4 times. I've watched virtually every Fed member talk, and that's the kind of analysis you're getting on these videos. There's actual work that goes behind these videos and context gathering, we'll call it. And we're seeing that play out today. As a matter of fact, I don't think the market reaction is even strong enough to justify what's been happening. So there's a whole lot of pieces we got to talk about. We'll start with what actually occurred. The Fed gave us a dot plot that was significantly more hawkish than the market overall had anticipated, where you basically have 2 out of 17 Fed members suggesting a lower than 5% rate by the end of next year. Okay? Important to note that the market, there's only 2 below 5% by the end of next year. It's important to note that the market before today was pricing in rate cuts at the end of next year and finishing the year at 4.4%. That was the assumed level. You've seen the Fed propose, and the Fed is the actual ones that are making the decision, a level higher than the market. I think the market has to do a greater adjustment. I think people were in the more 5% camp when the 10-year peaked. I think the 10-year has to get back to that peak. That just seems like the appropriate level. It seems quite low. If you look at the longer run levels of interest rates, they're at roughly 3%, we'll call it. Well, that means the 10-year's got to be higher than 3% if it were at the long run low. But we've got this period where we're above 5%. So it seems to me that there is weirdness, underpricing going on in the market. And as a matter of fact, right before the quiet period, the Fed was saying as much. Jim Bullard verbatim explicitly said the market was underpricing the risk the Fed would be more hawkish. My assumption is over the next couple of days, we'll get several Fed members coming out and talking and hammering down that this is the consensus view. Powell seemed very clear that they're not even going to entertain the idea of rate cuts next year. And that's what you need to get an equity market rally. Because let's not forget, this is an important thing. It would be one thing if the market was down 50% and we knew everything with rates. That would be a different situation. It would be hard to get additional downside. However, we've experienced a roughly 14-15% rally here, depending on where you're, this point to the bottom point, exact, I don't know. We're talking right before the Fed meeting, whatever it is. We're up double digits from the lows. That's a lot. We're barely down on the year. The Dow is down like 8% for the year. The S&P 500 is down like just over 13% or something. It's like not a whole lot of change we're talking about here. But interest rates have gone up tremendously, and they're currently a little too low based on what the Fed is saying, based on reality and market dynamics. And additionally, the fact that they're offloading bonds into the market. There's a number of strange things. We can't expect it all to play out in one day. I expect this to be a multi-day process, multi-week process. And then we'll kind of reevaluate with additional data. But don't think you know where that data is going to come. Don't think it's definitely going to stay on this trend. You know why? And this, in my opinion, is the most important reason why the Fed is remaining hawkish, or at least one of them, a very important thing to consider. Core inflation, as Powell has said, and we have talked about and written in these quote threads on Twitter, that core CPI has basically gone flat, or core inflation rather. There's 2 different core things that are similar metrics. They're doing the same thing. That core inflation has virtually gone sideways all year. That is true. It's not like CPI. It didn't peak when CPI peaked. After CPI peaked, it came down for 2 months. Core went up for 2 or 3 months. And in the last 2 months, come down in CPI, but it's not broken that range. In fact, it's only given up in the last 2 months, the 2 months gain that was experienced in the prior 2 months. So 4 months total we're talking about here. It's flat in the last 4 months. It's flat where it was a year ago. It's higher than where it was 5 or 6 months ago. It's sticky. It's sticky. And the biggest part of this core inflation, 55%, as the Fed chair said today, was essentially labor. There's no sign of wages coming down. As a matter of fact, if I remember correctly, they reaccelerated. So you see that. You see food prices up quite substantially. Here's the big thing that I was talking about. Those are all big things too. Oil prices have come down. In my opinion, my understanding, that is virtually the catalyst that has brought CPI down. That and that alone. Because everything else is still going up, except used car prices. Oil, I expect to go up. The SPR is ending. We've seen a roughly 10% move in the last few days. We've seen a tremendous pullback, granted, but it's almost entirely coinciding with the SPR release. China's and Iran negotiations, which don't seem to be occurring. There seems to be something with Venezuela. I would not expect much out of that. It's not even that much production. And OPEC just said they expect supply to go up next year less than demand is going to go up. Demand is going to go up 2.4 million barrels per day. Supply is going to go up 1.8 million barrels per day. You do the math on that. You tell me how there's not a price increase with a supply deficit. Tell me. How do prices not go up? Prices are going to go up. So the force that has made the pullback in CPI inflation and CPI inflation alone occur is seemingly going to reverse, because not only do you have a supply-demand deficit, you have SPR releases coming offline. Maybe that's in the 1.8. We'll see what happens. Either way, it only takes small changes in supply and demand to see a strong price. I'm not saying $200 barrel oil, but I'm saying the trend of falling prices over. And that probably leaves us with the demand for rising prices, leading us into the $80 to $100 range is my assumption. Oil is anything but flat, but that I think is the range that's appropriate. That's higher than we are now. SPR releases are weird. It's like you give oil to the companies to refine, and then they put it on the shelves and they have to sell it. So I think there's a little bit of an additional decline in gas prices because of the way the actual SPR release works. They're giving it to Exxon to refine and then putting it in the gas stations, and they're flooding the system essentially. And I think that flood has done some things. So I think when there's less of a flood, even if the price of oil is the same, prices will still go up, is what I'm trying to say. The bigger point here, though, is oil is done going down, as far as I can see. That is what's brought CPI down. So at the very least, you would have to assume CPI is going to stay flat, especially while spending is up and wages are up. You then take oil potentially going up, and what does that mean by the transitive property, what I just talked about? Prices probably go up. I'm not saying it's going to happen. I'm saying I think I can see how it would happen and why I'm not getting all bulled up on inflation coming down. I don't think that's happening. I think we might get some December CPI data that's going to be okay. But in January, what if it reaccelerates? What do you do then? What do all these people saying inflation is going to fall like a rock do when oil prices go back up? I don't know. We'll see what happens. We're going to have to see how things play out the next couple days. But we've obviously made clear where our work is leading us on the Fed. And while the market may have talked about, acted upon, and moved in other ways, our work is telling us something else, and we're sticking with that. Ultimately, as Ray Dalio says, in order to make money in the market, you have to bet against the consensus and be right. We are not anti-growth. We are not anti-future developments. We are not anti-renewable energy. We have spent more of our time in this fund being long than short. As a matter of fact, we have plenty of longs on the table. However, right now, it seems that there's a lot of bullish sentiment. People have been ingrained in this. There's been a rally here. They're caught in a trap, and they can't reverse and admit that this Fed meeting was very hawkish. They couldn't admit the last one was very hawkish. But guess what? We got a 3% move in an hour, and then we just gave it all back right after that. We peaked on that. Make no mistake, the Fed is hawkish. That's today's video, and until next time, peace out.